Hello and welcome to our quarterly review. Today we're taking a closer look at how the financial markets performed in the first quarter 2025. So we will discuss how different bond funds or equity funds have developed in the first 3 months of the year. And of course, we will also give a brief outlook for the remaining year. In today's video, we are joined once again by Mario, Chris and Yisheng. Hello everybody.
Hello.
Hi.
Hello.
Okay, so when we look at the development of the first 3 months, one must say that January was quite a good performance. But when we are looking at February and also March, we can see that especially on the equity side, we have negative returns. What is the reason for that development, Mario?
Well, to summarize it, a Trump bump became a Trump slump, just like that. And I think very few people expected this to happen because I guess a lot of people spoke about a Trump trade that was U.S. equities, U.S. small company stocks, crypto, U.S. dollars. These were expected to be the winners of Trump's second presidency, and they had very strong performance into the end of 2024 and also the beginning of 2025. But somehow it all ended at the inauguration of Trump on January 20th. And since then, pretty much all Trump trades have turned in the opposite direction. The dollar weakened, specifically also against European currencies, but also against Asian currencies. Dollar lost almost 5% against the euro, which is very unexpected. Last year, everybody spoke about euro dollar parity. Now we're looking at almost 110. And most of all, China. China was expected to be a big loser from Trump's presidency, but the Chinese stock market did very well so far year to date. And this was truly unexpected. If you look at the MSCI World Index ex United States, it's up almost 10%. If you look at German stocks, they're up more than 15%. Chinese stock, Hong Kong stocks are up 15 plus percent. This is truly unexpected. So the world looks very different today. Magnificent Seven have corrected sharply. Some of them are down. If you look at specifically at Nvidia, is down more than 20%. But why was that? I suppose when I was working in New York, we used to say more buyers than sellers and more sellers than buyers. I guess everybody who wanted to own crypto, Magnificent Seven had it when Trump got inaugurated, and there were no more people left to buy. At the same time, everybody who felt bad about China or bad about Europe had probably already sold. So as soon as sort of a rebalancing mindset came in the picture, I mean, just picture how expensive the Magnificent Seven are. I mean, the market capitalization has been several trillions, and we're just looking at 7 companies. So if you just take a little bit of money from these stocks and shift it into Asian stocks, shift it into German stocks, this will naturally result in price movements, and I guess that's what we've seen. But it also shows that ultimately, as an investor, it's important to look at valuations. Don't chase certain trends unless the valuation is fine and you don't mind having a trade become a long-term investment just because you're comfortable with what the asset is and what the valuation looks like. This could potentially be a problem with gold. Recently, I've been thinking about gold because everybody's chasing gold, and it looks like there's no reason not to own gold. But if I just look at the technical picture, the gold price has moved quite a bit away from the 200-day moving average from intermediate trends. So this could be an area where some people may be disappointed if they just jump on the bandwagon. I mean, I do see value in having some gold in a portfolio, but do I need to buy it today at today's price? Maybe not so much. And especially if I'm reading that Indian retail investors who are unhappy about how Indian equities are doing are now piling their money into gold, that also makes me wonder. Sometimes such kind of news can give you an idea about the future market direction. When we read about Indian men moving from the countryside into the city to trade stocks, that was probably the right time to stay away from Indian stocks. But now that they're depressed and they're shifting into gold, maybe it's a good time to look at Indian stocks again. I'm not advocating to pile a lot of money into India now, but the news flow seems to be more supportive for better prices in the near future than it was in September last year.
Yeah. Mario, how do you see the long-term structural changes in the financial markets? Are we entering a longer period of volatility?
Um, I would say as long as Trump is U.S. president, we have to live with more volatility or higher volatility, and we can see the VIX index, which reflects the volatility in the S&P 500 index, is above 20 and has been there for a couple of weeks now. This is something we haven't seen in the last many years. So volatility, I suppose, will be higher under Trump. I mean, a historic volatility of 20 isn't also a dramatic thing. Maybe markets are becoming a little more normal and moving away from that stability that we've seen in the last 2 years, 2023 and 2024. But yeah, it's a bit unnerving, these constant shifts in news flow and no reliable decisions. This certainly breeds uncertainty, or has already bred a lot of uncertainty, and this is why investors in certain winning assets have been taking chips off the table, have been moving to the sidelines, have been shifting away from US tech stocks and into other markets, and also have been shifting into bonds. In fact, year to date has been quite a good period for US bonds. While these bonds lost some into mid January because of the fear of inflationary policies, ever since markets realized that Trump is breeding uncertainty, this has effectively created a risk off environment where people have been moving away from risky assets and into also fixed income, into international equities and into fixed income and gold. But to answer your question, Chris, I think it's best to to be neutral. I don't think this is an environment for big bets. I wouldn't bet aggressively against America. At the same time, I wouldn't bet aggressively in favor of China or Germany. So a broad-based global investment strategy is probably the way to go in the current environment.
Yeah. Talking about fixed income, um, why do you think that, or why are active bond strategies performing better than their index counterparts at the current time? What's the reason?
Um, this is something we've been observing for a long time, because let's say in the equity markets, we realize that most active stock portfolio managers don't manage to outperform indices, which is why most of our recommendations are basically index heavy. We recommend broad based indices and only have a small selection of active equity managers. For once, there are only a few managers that can really beat the indices. Luckily, our clients can buy them at very low cost, which is why a comparison between active management and indices looks a bit better in our perspective. But on the fixed income side, it's quite the opposite. If you look at the mechanics of bond indices, in general, you see a heavier allocation to highly indebted issuers or countries. So a broad-based bond index will hold a lot of Japanese bonds, Italian bonds, and if you picture yourself as a bond investor, you're basically lending money to somebody or to an entity, to a country, and your main objective is to get your money back. So So you wouldn't necessarily want to have so much debt of, let's say, Chinese property managers. Yeah, if you look at Asian high yield bond indices in recent history, they were heavily allocated towards Chinese property companies, and that was exactly the kind of industry that you wouldn't want to lend money to. At the same time, actively managed Asian bond funds, high yield bond funds, they stayed away from Chinese property companies and thereby had a much better performance. And we see that across the board. So fundamentally, we can really see that more concentrated, higher quality bond portfolios are doing much better than the broad-based bond indices. So, in contrast to our perspective on equities, where we actually recommend index investing, we feel that in the fixed income space, active management purchased at low cost, this is very important, purchased at low cost, does typically beat indexing in the fixed income space.
Mhm.
And that's not just a temporary phenomenon. This has been like this for a while.
Yeah.
So this is a big week for tariff announcements. I think Trump has a so-called Liberation Day planned today in the Rose Garden, and on Thursday there's the tariff announcements coming up. Do you think there's any scenario where tariffs could actually be good for U.S. stocks in the sense that it protects the local domestic firms, which could translate into some stock performance, or do you think it's necessarily going to be a bad thing in that it may cause a recession in the long term? Do you sort of see the tariff being something that can be traded around or something that should just be business as usual in terms of the portfolio construction?
Well, as we've seen, the whole tariff discussion has bred a lot of volatility. So you could, if you followed the trading strategy, you could actually probably earn money. Just if I look at the price movement of Tesla shares, you could do a lot of intraday trading, but that's also very risky, and I wouldn't advocate that. Tariffs as such are really, they're like a tax. So I cannot foresee how this will how will how this will help anybody. Of course, in I mean, ironically, this is what countries used to do to protect their industry. I mean, for the longest time, Japan has been protecting their rice farmers, or Korea has also been protecting their car manufacturers. But if you're confident about your product, if you're confident about the prices you can charge, you don't need to work with tariffs. Yeah. So, I mean, what I find highly questionable is the ambition of Trump to use the tariffs to effectively earn income for the U.S. state, and then use that money to lower taxes in America, or create a sovereign wealth fund based on tariff collections. I consider this very ambitious, and I have a lot of doubts if that could really work. And the idea of bringing manufacturing back into the US, on one hand, the US the US employment has been very high. So I'm wondering where these additional workers should come from. And it looks like the US economy is not looking for manufacturing talent, but rather looking for IT or AI related talent or services talent. So, and I do remember that America looked down on Europe, on Asia, for sticking with manufacturing. Yeah, we were always considered the old world that still does manufacturing, while the US and UK to a certain degree had already moved on to the service economy. So, long story short, I don't think tariffs are a good idea, and I don't think they will help the US economy. Um, and but maybe if Trump really goes ahead with tariffs as high as 25%, um, to effectively punish certain countries. I actually have the feeling this is not only about helping the American workers or certain American workers. I think this is really about redefining foreign policy, and redefining friend and foe. And I think that's very dangerous. We already see the uncertainty. Markets that don't know how to organize themselves, or companies that don't know how to organize themselves, they will not take any decisions. That means this will slow the economy. Will that lead to a recession? We don't know. Um, but it's certainly, I doubt it's good for the U.S. economy, and so I don't think it's a good idea. And I mean, we know Donald Trump hasn't been a successful businessman, right? So unfortunately, this time around, he was able to surround himself with like-minded people, like-minded characters, and and maybe he's going to mess it up. This may be possible, yeah. But at the same time, we mustn't forget that the true DNA of America is that of a capitalist nature. If at some point he will overdo it, he will really mess it up so hard. There's strong economic interest in the states to rectify this and find a way to deal with him and get rid of him. I mean, he can be voted out. I'm sure this is possible. But until then, I think the best way to go about this is to just ignore the noise, focus on the valuation of certain assets, pursue portfolio construction as we're advocating. That means if you need your liquidity fast, stick with high quality money market vehicles. If you do think you don't need your money for a long time, allow yourself to invest globally in global equities, be it liquid or illiquid. In fact, I think this year clients may benefit from a certain allocation to private equity. Private equity didn't have such a good year last year and also the preceding years. Valuations are okay. Adding a certain amount of a leverage buyout in the right way, the right product, the rightly priced product, this may help a portfolio this year. But I think there are plenty of opportunities. Inflation is receding. Interest rates are attractive. You get paid for waiting. At the same time, if you're willing to take the plunge in equity markets, valuations are generally okay. Um, it's not a bad invest. It's not a bad environment. I actually think it's a good environment for a balanced portfolio, be it 60-40 equities or 60-40 bonds. I think it's not a bad environment. Just strip out the noise.
Do you think, in that regard, that there's any capacity for tariffs to create regional winners or losers, in the sense that the MSCI World Index is still 70% US? Is there any needs for clients to look at this percentage allocation to the US versus other countries, or do you think it is fine as it is?
Yeah, I think such a heavy allocation to the US is probably not necessary, I would say, at this stage, because provided you have it already, I think the question is, would you need to diversify out of it? Sometimes I'm asking that myself if I look at client portfolios where we have the MSCI World Index, and I'm wondering, should we shift that into MSCI World Value? Should we shift some of it into Asia? Should we shift some of it into Europe? I think it's okay to reduce US allocation to a certain degree. Let's say if your US allocation was 70-80%, you may want to bring this down. But I would also not want to do without the US. If you look at the S&P 500 or the S&P 500 equal weight, or if you look at US small mid-cap companies, valuations are okay. And so I would want to maintain a significant allocation to the US, but don't be as aggressive as we were into January 20th, effectively. And be very careful with the Magnificent Seven. If I look at the charts, the technical picture there, it looks like we're now firmly below the 200-day moving average. It looks like this is a market that wants to consolidate. There's no urgency in buying anything. Maybe no need to buy the dip. Just wait for valuations to improve, and in the meantime, collect interest. There's enough interest to be collected if you're a dollar investor. But I think there will be a rebalance. I mean, it's already happening, the rebalancing, and I do think this will continue. The question is, where do you find? How do you rebalance, right? Let's say if you look at international quality companies, they're also not cheap. So you basically have to move out of high quality US stocks into lower quality international stocks. I'm also not sure if that's a great idea in the long term. But maybe it's a short-term idea for cash. So let's say you buy your bonds, you buy value stocks, you buy dividend stocks until valuations in the quality space become more attractive again, and then you make that long-term switch into quality strategy.
I have one more question regarding the funds and ETFs that are offered by this family office. So we can see that most of these funds and ETFs are traded in US dollar. However, the US dollar has recently lost value. So now the question is this a disadvantage for investors?
There are two aspects here. The denomination in US dollars allows a US dollar investor to not have to convert. Let's say if a US dollar investor were to want to invest in Singapore or in Asia, he would then have to buy several Asian currencies, some of which are regulated, and this could be quite costly. So it's actually very convenient if you can buy Asian stocks or Asian bonds in US dollar denomination. At the same time, you need to be aware that what is held within the vehicle, be it the ETF, the fund, that this may not be a US dollar asset. Let's say if it's a Singapore government bond, then this is a Singapore dollar exposure, even if it's denominated in US dollars. So this is very important. If a dollar investor is of the opinion that the target investment will lose in value against the dollar, you need to either buy that target vehicle with a currency hedge, which is sometimes possible, or you should just not do it. At the same time, nowadays, that let's say the US dollar may have peaked for a while, you could then specifically gain from buying investments that are denominated in other currencies, be it Sing dollar, Japanese yen, Chinese yuan, euro, sterling, Swiss franc, and thereby benefit from the fact that these currencies and assets may appreciate in value against the US dollar. This is always important. If let's say your reference currency, be it US dollar or Singapore dollar or euro, you need to then create your portfolio based on that reference currency. And let's say in Asia, we have a lot of investors who are referenced in dollar, but de facto they spend local currency, be it Thai baht, Singapore dollar. So they need to look at that, especially now that the dollar may have peaked. The Asian currencies may do better, so you may want to increase your allocation to Asian assets or European assets or assets where you assume that they have a chance of appreciating vis-a-vis the US dollar or US dollar investments. But in the long term, in general, the rule of thumb is for long-term equity allocations, we don't worry about this because broadly diversified equity markets will kind of deal with currency fluctuations. There will always be companies that benefit from currency movements and companies that suffer from it. But where this becomes very important is on the bond side or the fixed income side, because let's say your reference in Singapore dollar, like Ishan and me, and we hold only US dollars in our bond portfolio or money market portfolio, and then the dollar falls 10%, then our purchasing power goes down 10%, and this is quite painful. So we need to be careful and need to maybe buy Singapore dollar money market investments, even if we get less interest. So, but this is an important aspect of portfolio construction.
Okay, so maybe as a last question for today's video, as a short summary, what do these developments mean for investors for April and also the remaining months of the year?
Like I said earlier, I think the current market environment is actually pretty normal. Let's say if we roll back in the time before before interest rates were basically zero, if we're looking to the early 2000s or the 90s, it was quite normal that you would get interest rates for your bonds, which currently we do again. This wasn't the case into 2022. The decade before was basically a zero or low interest rate period. Now we're getting paid, and inflation has come back. So it's actually a good environment for fixed income investors and for patient investors. At the same time, global equity markets, except for US large cap, are also normally valued. So it's actually a really ordinary, normal environment to put your money to work, except for the fact that you have a really noisy person in the White House that creates a lot of anxiety. But just ignore that and go on with your portfolio construction. And don't be, I mean, to some degree, the current period reminds me of the late 90s, early 2000s. I remember when the NASDAQ peaked then, people that hadn't bought into the tech stocks were keen to put money to work, only to see their money really go down a lot into 2002. Yeah. So I would recommend that whoever doesn't own Nvidia now or doesn't own some of these tech darlings, don't chase old dreams. Build your portfolio from scratch. Try to look at current valuations, and don't try to buy great trading ideas of the last 2 to 3 years, because these are the ideas of the last couple of years. These are probably not the ideas for the future. Because if you did that in 2002 and you bought, let's say, Cisco Systems then, you wouldn't be happy now. But had you allowed yourself to just buy an ordinary, broadly based MSCI World Index, as we mentioned it earlier, you would have been just fine, or the MSCI World Value Index. So try to build a portfolio independent of certain ideas that you like a lot. Investment management, portfolio management has to be boring. It's the purpose of a quality investment portfolio is not that you have an amalgamation of sexy ideas. You need to construct a portfolio that makes sense, and current valuations allow you to build a portfolio that makes sense. So ignore the noise, or maybe enjoy the noise, because on some level it's entertaining, and just let your money do what it does best. That means, yeah, create dividends and interest for you. And be careful with gold. I would probably not chase gold at the moment, even if it sounds like such a great idea. And reach out to us. We're always here. Luckily, our client community is not very nervous and not very anxious. But if you feel like you need somebody to talk to about your investments, we're always here and we enjoy the discussion with you.
And you can find the link to our new quarterly reflections also in the video description. So over there you can find like all the developments for different portfolios, the current valuation of different sectors and countries, for example. So you can have a look over there. And if some questions are left, you can always contact Mario or Ishing. Okay, so then we will see each other again in around 3 months, so that we can reflect on the second quarter and we see how the markets developed.
Yeah. Enjoy the Sakura season. I see a lot of people going to Japan to enjoy Sakura. We'll be enjoying Sakura in Munich, from what I understand. We'll be going there this weekend. Have a great day. Bye
See you in
bye.
Munich.
Great day.
Bye.
Bye.